All right, welcome everyone. I'm Chris Herbert. I'm the Managing Director of Harvard's Joint Center for Housing Studies. And we have opened the doors and people are coming in. I'm just watching the participant list. I might give it another minute before we formally start to make sure everyone has a chance to find a seat. Well, good afternoon, everyone. I'm Chris Herbert. I'm the Managing Director of Harvard's Joint Center for Housing Studies. Very pleased to host today's discussion with Don Layton entitled A Consequential Proposal, the FHFA's GSE Capital Requirement. When Mark Calabria became director of the FHFA last year, he made it a priority for his tenure as director to see the GSEs through to being released from conservatorship, a state they've been in since 2008. There are a lot of steps that Director Calabria has on his plate in leading the GSEs to this privatization, but perhaps none more consequential than establishing the capital required by these entities. It's important because it sets the bar for how much capital is going to be required to release these back into these entities into the private sector. It's important because it is foundational in establishing the safety and soundness of these organizations in a host of ways, as Don will discuss today. And it's important because it has implications for the cost of mortgage financing and the availability of mortgage financing throughout the economic cycle. And with more than $5.7 trillion in assets between them, Fannie Mae and Freddie Mac, when these offerings come to the public, they will be the largest public offerings in history. And so while we know that requiring a large amount of capital is going to be necessary, the question of how much is consequential for that process of privatizing these entities as well. The FHFA proposed a capital rule under the previous FHFA director, Mel Watt. When Director Calabria came in, he assessed that process and basically decided that in the situation where he is now looking to lead the organizations into not a theoretical release, but an actual release in today's market, that it was important to reassess that rule and to bring it out for public comment because he really does hope to follow through on this in the coming years. And so in May, the newly proposed rule was released, which for all the reasons I've just described is very consequential. And as a result, the Joint Center is really pleased to have this forum today to be able to hear from Don Layton, who is a Joint Center Senior Industry Fellow, has been with us for the past year, and joined us after retiring as CEO of Freddie Mac, where he had served as CEO since 2012. Don has spent the past year sharing his observations about the evolution of the GSEs over the period of time when he was at the helm, and as well as his view of the issues that need to be addressed as we move the housing finance system into its next phase, where the GSEs are once again private entities. Don brings a unique perspective to the conversation today, in no small part because as CEO, he was instrumental in helping to establish the conservative capital framework, which was the basis for the 2018 rule that was proposed by FHFA. But in addition to his time at Freddie Mac, Don has almost 3 decades, yes, 3 decades. He looks as well as he does, but he's been around a long time in the banking system. And in that banking system has had a front row seat to both the evolution of bank capital requirements, the failures of those bank capital requirements, and the changes made over time to try to address those previous failures. So for all these reasons, Don, I think, brings an enormous amount of expertise to this role. I'd like to point out that Don does not have a financial bias or a financial stake in this issue. Under the terms of his time at Freddie Mac, he has no stock and he is not gained from this process. I will say that he probably does have the bias, a bit of a pride of authorship, that Don's tenure at Freddie Mac was consequential. He did have a role in these matters and so does have a point of view. But I think Don, as he said in his outset of his establishment of his fellowship here, his goal is to be a technocrat, someone who hits the ball down the middle of the fairway, as he puts it, who is intended to look at this to say, how should the system designed from the point of view of the public to be efficient and to be safe and ensure safety and soundness. So I think Don is a voice that we'd like to hear from on this topic. I should also point out in a full disclosure that I serve as a director of Freddie Mac. I am not here today to share my views, but to the extent that any views do come across, they're mine and not that of Freddie Mac. So with that, What we're going to do today is I'm going to turn it over to Don now, and Don is going to go through about a 20-minute presentation, so sharing his high-level review of the FHFA proposed rule. I'll ask Don a couple of questions, and we'll open it up to the audience to propose questions through the Q&A feature here. So without further ado, let me turn it over to Don. Don, welcome, and thanks so much for being with us today.
Okay, thank you, Chris, and welcome everybody. Chris, would you put up the slides, please?
Yep.
Chris said I have about almost half the time we'll go to a presentation. Everything about mortgages and everything about this capital system is extremely complex, so I'm trying to keep it at core principles and higher level issues. The proposal itself is over 400 pages. For those who are not digging into technical details, there is a 16-page fact sheet, which is definitely worth a read and tell you what's going on, and that will tend to inform a lot of my comments. Okay, next slide, Chris. As Chris said, I've been around a while, the banking system, quite a while, and so there's a whole bunch of background here that this cap proposal comes after, decades after. So setting the stage here, before 2008, minimum regulatory capital requirements on mortgage-related firms that were supervised by specialty mortgage regulators were very low. I'm talking about the thrifts and the GSEs and the home loan banks and all these other special ones regulated by Federal Home Loan Bank Board and the OTS and OFEO, predecessors, all these organizations that were predecessors to the FHFA. Even by the standards of the day when bank capital was low, mortgage-related operations in these specialty companies were even more low. So going into 2008, they did not perform well. And the broader banking system, the mainstream banking system capital reform, was all about higher. Dodd-Frank really could be summarized as higher. And there are three core regimes of looking at it. They didn't come up with one killer capital approach. They keep adding different ones. You have to meet the higher of. There's the historic leverage ratio, just capital divided by the accounting assets. Again, I'm going to stick to the core. These days, there are lots of adjustments to make, but it's the basic leverage ratio. That goes back well into the post-war era, way back, and is your core simple ratio. Then in response to that not working too well in the late 80s, the main banking regulators across the developed world got together via Basel and did risk-weighted system. Simple. The idea was different asset categories have different risks, and they did a very crude approximation. A corporate loan was 100%, a treasury security was 0, and a residential mortgage was generally 50%. And they set up standards. It evolved over time. It did not do well going into the financial crisis because it was too biased towards recent history of statistical likelihood of loss, which of course had been a great period, so risks were calculated as low. And then they came up in the cauldron of 2009 and 10 when the markets had little confidence in banks broadly internationally, with the CCAR, or known as DFAST sometimes, stress test approach, where they put in a severely adverse scenario, calculated what you lose, and then said you had to have a somewhat arbitrarily or judgmentally determined going concern buffer that you would still have market confidence after this giant loss. So these are the three regimes that are competing in bank capital systems, although over the time it's got very complicated and there's more than a dozen different particular measures and ratios, but they all come back to these three. And it was driven, I would say, this is an opinion, primarily by technical or technocratic policy, but there clearly are some areas where politics intervened to have some decisions be biased one way or another. Slide, Chris. Okay, the other thing in background is when the GSEs entered conservatorship in 2008, it was assumed it would be a short-term, and I believe it was like a timeout was the description by the then Secretary of the Treasury. In reality, as the years wore on and it was realized that it was going to be very hard for everyone to agree to a way for them to exit, without changes in the business model about which there's disagreements politically. The powers that be decided, this is starting roughly 2011-12, that we should reform the GSEs while they were in conservatorship in several key ways. In fact, here are three of them. One of them started right at the beginning. One considered abuse of the GSEs. What they had was implied guarantee funds, i.e. very cheap subsidized funding to support discretionary large investment portfolios that totaled over $1.5 trillion between the two companies. That was scheduled to be eliminated or substantially reduced in the original takeover back in 2008, bring down from over this $1.5 trillion down to under $0.5 trillion. Next, the other was to develop what Chris mentioned, a notional regulatory capital requirement. The GSEs as financial institutions could make a decision about whether to dispose of a impaired asset at a certain price because you didn't know what the measure of capital reflecting risk was. So we developed inside conservatorship a risk-based capital system for making those decisions called Conservatorship Capital Framework, or CCF, which was, and I'll describe this, meant to be pretty consistent with a lot of things happening in the banking system. And the third is that we addressed a weakness in the system in which the GSEs were, by their congressional charters, concentrated monolines in residential mortgage credit risk. This kind of multi-trillion-dollar concentrated is a systemic problem. And so we attacked it by doing credit risk transfer, in which we would distribute the risk at a good price to diversified investors, and thence reducing systemic risk of the system. And additionally, the way we did it, it also was very efficient on behalf of the companies themselves. Slide, Chris. Okay, so with that background, we go to the FHFA proposal. This is just a summary, no comment. Here's some key highlights of it if you get through all the detail. It has a leverage ratio. 4% of assets with a few adjustments works out to be on their baseline $243 billion. It consists of two components, but the total of the two, 4%, is the most relevant one. It is specifically designed and stated in the document that it should be binding, i.e. higher than a risk-based measure. Cyclically, when times have been good, it should be binding, that's the way it should work, and that currently it is binding. Second, there is a risk-based system based upon CCF. CCF is largely a Basel style, like the banks use, but not 100%. There are some stress test components in it, but it's largely Basel. And they did three different types of calculations and took the maximum of the three and got $135 billion for their baseline. And then added buffers, discretionary buffers, an amount highly arbitrary and judgmental of $99 billion to get to $234 billion as a risk-based calculation, lower than the leverage ratio. This system has lookup tables, it has floors, it has maximum of, it has many nonlinear features. It's very complicated. And it has specific features to offset the pro-cyclical economics of the business. The reality is the mortgage guarantee business of the GSEs is highly pro-cyclical with respect to house prices. And that creates the problem of, if times are good, you have enough capital to cover the risks, but if then times go bad, you can't raise capital to cover the increasing risk of your existing book. So there's some kind of notion of a countercyclical amelioration. It does have several of those in there. What is missing is there is no CCAR style stress loss plus going concern buffer approach, which is the core of the CCAR process, since made more complicated by the bank regulators. Even though they do stress loss calculations to Fed design. And so it is not overtly there. We will talk about that more. I do note in 2009 and 10 that CCAR stress loss plus going concern buffer was developed to reestablish confidence in the banks, because the other two approaches of leverage ratio and risk base are somewhat arbitrary. Saying you have a 5% ratio or an 8% ratio, what does it mean? In that time when people were so worried, the CCAR spoke to them better by saying they could lose money but still have enough left over to be adequate. That got confidence back. Okay, next page. So concerns, here we go. High level. Complexity is very high. Everything in the mortgage business is complex. This is no exception. There is a question whether it might be too complex. The cyclically binding leverage ratio is an issue. While it says it makes sense for the leverage ratio to be binding cyclically, in fact, that is at odds with the Basel and normal mainstream regulatory doctrine. When the mainstream bank regulators around the world got together after the financial crisis, they decided that the role of a leverage ratio, a classic accounting-based leverage ratio, was to be a backstop if risk-weighted mechanisms somehow were gamed or went awry. And they determined that for banks internationally, it had to be a minimum of 3%, well under what you would keep on a risk base. The current vice chairman of the Fed for regulation, in fact, has made speeches about the problem if a leverage ratio ever becomes binding, which I'll talk about later, because it leads to distorted decision making. Third problem and structural concern is there seems to be a bias in this against CRT, credit risk transfer. Somewhat maybe pro-PMI, meaning mortgage insurance, which is inconsistent because it's just another form of CRT. And so it quite surprised everybody that credit risk transfers seem to be getting so many haircuts and knockdowns that it might not be economically effective. And the last one, which is poorly worded in this slide, is there is a notion that there's two capital ratios. I mentioned the 4% leverage ratio. 2.5% says you're fine, but you can't do any distributions to your shareholders, no dividends, no stock buybacks. And you can't do executive compensation unless you're above 4. So while technically the requirement is 2.5, in practical terms, no company is going to aim for anything less than 4. They have to hit both. So it's not really, this 2.5 is not meaningful relief. 4 is the target. And I have to add that in the real world, you can't run at the regulatory minimum plus $1 or $2. You need a buffer. The buffer will vary by management judgment of the volatility of the business, but at the very least, it's another 5 to 10%. So you're talking here about not just $243 billion is the minimum, but these two companies together probably looking more in the $260, $270, $280 billion range for capital as defined. Okay, Chris, thank you. Policy analysis. So I got 4 ways to look at this. The first 2 are about just any capital system. A capital system is designed to do 2 things and answer 2 questions and do 2 things right. Is the capital roughly at the right level? It's a macro question for safety and soundness. Don't get fooled by precision. The 243 really is plus or minus 20%, but there you have it, the macro. This question 2, which has bedeviled banking regulators for a long time, and many people do not know about it, is that the capital system, the regulatory capital system, should also incent good economic risk-reward decision-making and not present false choices that distort things. I'll talk about this more. It's been a constant problem for bank regulators. Question 3 is systemic risk. The GSEs are not capital S SIFIs because they haven't gone through a legal process to be so, but they are certainly lowercase s SIFIs because they're so sizable and so materially concentrated risk and so interconnected with others that they do propose systemic risk. Does this capital system tend to lead towards it being higher or lower? And the 4th is, what's the impact on people? What's the impact on the housing and housing finance system? Because that's what these companies actually do. So I'll go through those 4 in order. Okay. The original 2018 capital proposal under Director Calabria's predecessor came out to a number of $137 billion. And the current one comes out about $243 billion. I am going to do 2 sense checks to see what these things look like. By the way, the difference between the two, $100 billion, is a very consequential amount. I'll talk about that later. It's almost like a tax on the average American if it's not justified. Sense check number 1. is to look at the implied going concern buffer. If the capital required in the old proposal and the new are listed here, and you subtract the loss under the severely adverse, it's called DFAST stress test. This is a non-cream puff, a severe stress specified by the Federal Reserve. And the most important variable for the GSE is that house prices generally are down about 25%, which is what happened roughly back in 2008 and subsequent years, when the core of the crisis was housing. I note that so far in the pandemic economic crisis, house prices, in fact, have not dropped at all. And they presented two numbers. The bigger one was $43 billion. If you subtract those, you get an implied going concern buffer of $94 billion and $200 billion. Is that big? Is that small? How do you scale it? You look at it as what times it is of the DFAST loss. So 94 billion is 2.2 times the 43 billion. So if this severe adverse scenario happened, the GSEs lose $43 billion, they still have 94 billion. They could do another two severe adverses and still have a few bucks left. For the current 2020 proposal, those numbers work out to be 4.7 times, meaning you lose the 43 billion, you can still lose it 4 times more and you still have a lot of money left over. That seems to be a relatively high number. What's interesting here though, is there are two DFAST loss calculations. One, the $43 billion, and the other is only about $18 billion. The difference is this complicated tax item called DTA. I'm not going to go into it. But if you lose the DTA, the loss becomes bigger. That's the 43. That's what happened in 2008 and subsequent years. If you don't lose it, then you have a much lower loss. When we started doing the stress testing back in 2013, it would have been lost for sure. At this point in time, it's likely it would not be lost. So that's another way to look at it. Based on that 18 billion, the old proposal 137 would be a 6.6 times going concern buffer. Well more than enough to maintain safety and soundness and market confidence. And on the current proposal, it'd be 12.5 times, way high. So I conclude, my opinion is that this sense check says if you had roughly $150 to $170 billion range, more than the original 2018 proposal modestly, but much less than the 243, that's a reasonable range, and that would meet the criteria of safety and soundness, but not excessive capital, which is an economic burden to the country. Okay, next slide. There's a separate sense check. This is comparing the leverage ratio to be SIFI consistent. I want to define SIFI consistent. This means the GSEs would have the same capital behind the same amount of risk as a typical large SIFI. This is not SIFI same. Banks, I know banks. I was in banking for over 30 years. This is, banks and GSEs are different, but they have a lot of overlapping risks, but they are not the same, especially when it comes to accounting. So SIFI consistent is the issue, not SIFI same. The proposed ratio was what I call here of 80%. The GSEs are looking for 4% leverage ratio, and the banks have a requirement for 5. Everything's complicated. The bank one, you could look at different versions. You come up with 6, you come up with 4. I'm using 5 as a directionally correct number. The problem is, and when I say banks are not like GSEs, GSEs have tremendous assets without a lot of residual risk these days. Over 90% of the balance sheet of a GSE is mortgage assets owned against which pass-through MBS has been issued. So what liquidity risk are the GSEs taking and that 90% plus of their balance sheet? None. It is passed through to investors. Banks pass through virtually nothing to investors. They retain all the liquidity risk. Interest rate risk. Mortgages are notorious for complicated interest rate risk. That's one of the reasons we got into the thrift crisis back in the 1980s. The GSEs on their 90% transfer virtually all the interest rate risk to mortgage-backed securities investors. The banks hold on to virtually all their interest rate risk. They try to manage it, but they're in the middle. Credit risk is the last one and the biggest one. The GSEs used to hold 100% of the credit risk, just like banks do. And it's concentrated in one category, which is problematic. CRT enters in here. Incrementally, we're doing over 70% of credit risk on mortgages are put out to the marketplace. On average, as the portfolio turns over, this has gotten to where over 40% is transferred out, and that number will climb every year as the portfolio turns over to get to the 70s. So we're in the middle of a transition. When you look at that, it is totally clear that the GSEs do not have 80% of the risk per accounting dollar on assets. Their 5.7 trillion has a lot less risk than 5.7 trillion of banks because they transfer so much of it out. They pass it through. So this 80% ratio of the 4% to 5% seems wildly high to me, and something more in the 40% to 50% range, even being conservative, is more reasonable. That would be a leverage ratio more in the 2 to 2.5% range of assets, or 122 to 152 billion dollars. I note that this comes in 120, 150. The prior check was 150, 170. And since the leverage ratio in classic mainstream regulation is supposed to be a floor below the risk base, they kind of fit together. So my conclusion all here is the $243 billion level is unnecessarily high, probably by 70 to 90 billion dollars. Next slide, please. The second criteria, does this distort proper risk reward decision making? When the leverage ratio is binding, as it would be today in the proposal, this is a well-known distortion of decision making. It takes us to the days back before Basel I, where the banks are starting to accumulate high risk assets because they look good as a high return on equity on banking regulators' required capital. And this is well known, well documented, and it's a problem. And also, a leverage ratio is against credit risk transfer, because credit risk transfer transactions do not, for the most part, give accounting relief. They stay on balance sheet. It's removing risk, it's not removing accounting assets. So you get literally no relief for doing a transaction when capital relief is the largest source of economics of why you do a credit risk transfer transaction. So it would tend to just present false economics, which would make all credit risk transfer transactions look wildly expensive as a way to get rid of risk, so they would tend to die. When the leverage ratio is not binding, and it is totally unclear what percentage of the time that would be, we don't know if the leverage ratio in this proposal would be binding a quarter of the time, or half the time, or 3/4 of the time. But when it was not binding, then you have your risk base, and you should have a better situation in terms of proper risk reward decision making. Unfortunately, the system developed in this proposal is so complicated, with so many buffers, floors, maximums, and other adjustments. It is so nonlinear, it is not at all obvious what the incremental economic impact would be of a particular transaction, at least at this time. So right now, the impact of this is unpredictable and would be very complicated to work through. So my conclusion here is this is a major weakness of the proposal, which is similar to what has happened in many prior bank regulatory proposals, inadequate attention to this. I do note that the current vice chairman of the Fed says he's paying a lot of attention to this. Okay, so let's move on. Systemic risk materially increased or decreased. Again, the GSEs are congressional charters that by law, they are mortgage monolines and create a systemic concentration of risk. GSE reform had CRT as the solution to transfer risk to diversified investors, not other monolines. And that makes the GSEs overwhelmingly risk pass-through entities, almost like operating trusts. Interest rate risk gets passed through with MBS, liquidity risk gets transferred with MBS, credit risk largely, not as thoroughly, gets transferred with CRT. The FHFA capital proposal will reverse this trend. The binding leverage ratio literally would eliminate the proper economics of CRT versus the false economics shown. And there's additionally, it seems like an anti-CRT bias to erode the benefit you get from CRT. So the implied, I'm not sure it's intended, but the implied FHFA vision is to reconcentrate credit risk back into the GSEs as they were prior to CRT, prior to 2008. And then address this heavy concentration of risk by requiring inordinately, in my view, high capital so you don't have systemic risk. And that kind of works. You won't have a giant increase in systemic risk. The problem is it's very inefficient. My analogy here would be auto safety. When they realized auto deaths were climbing after World War II in the 50s and 60s, they came up with seat belts and then shoulder belts and then airbags. You could have solved the problem by just putting a national speed limit of 20 miles an hour on, even on highways, and you would have solved the problem. It would just been outrageously inefficient. This to me looks like an inefficient way to address the issue. That extra $70 to $90 billion of capital, by the way, roughly translates into about $75 a year per household in the US, like a tax. So I think there's materially increased systemic risk. It's offset by overcapitalization, but that's a very expensive way to solve the problem. Next slide. Okay, I know a lot of people are waiting for this. So what's the impacts on housing and housing finance? I have 6 or 7 of them. This will have a major impact on the cost of mortgage credit and its availability. Guarantee fees, the core revenue of the GSEs, will need to go up to be able to have a proper return on the shareholders' equity. I remind everybody GSEs are an unusual hybrid. They're partly shareholder earned, and in many ways, they're like government agencies. So I estimated they would have to go up at least 20%, so roughly an average of 50 basis points to roughly an average of 60. Excuse me. I've seen other estimates that are higher. And credit availability will be down. If you raise the price of something, you get some less of it. Would there be a major increase in taxpayer risk? The answer here is yes. Secretary Mnuchin, in a public speech, made it very clear he did not want GSE reform to have as a side effect that a lot of credit exposure mortgages would move from the GSEs to the Federal Housing Administration, where there is zero taxpayer, private capital in front of the taxpayer. No credit risk transfer, no shareholders' equity. This would, in fact, do what he said he didn't want, because the GSEs would be priced up, would be much less competitive. We can talk about this if you want. That would result in money flowing, mortgages flowing to FHFA. They would grow. Would there be a return to GSE systemic risk concentration? Yes. In the long run, about $3 trillion or so of asset equivalent would move from diversified investors back to the GSEs. Next slide, please. Would there be reduced LMI is a phrase used for the GSEs. It stands for lower and middle income. That's our target market of the GSEs. Would it have reduced LMI economic security, especially minorities? The answer is yes, but it would be offset by any FHA take-up, so the net would probably be modest. Would there be mortgage origination to fewer larger firms? The business model of the GSEs is very friendly to independent mortgage bankers. There are over 1,000 originators of mortgages, bank and non-bank, to the GSEs. The FHFA and VA model, which works through Ginnie Mae, is more operationally difficult and is less friendly to the independent firms. So only the larger ones really can do it. So they only have about banks and non-banks of 400 something last I looked. Those other firms will have issues whether their business model survives or whether they have to sell out or how well they do. That's a core constituency that will be impacted. And of course, a very political issue. What would be the impact on raising capital to exit conservatorship? The reality is it would be negative, maybe material. Why? Return on equity of the firms reduced, the denominator goes up, their ROE goes down. It would be below market standards, maybe 7% or 6%. And it would prices be raised. It would take years to run the book up to have the ROE. So you'd be selling stock of an underperforming ROE firm. Its market share and therefore volumes would be shrinking because its prices were raised so much, and it would be reconcentrating risk, which makes it more volatile. Add those up, it doesn't become anywhere near as attractive a stock as it might be. So that's my basic summary. And now we're going to go to Q&A. Took a few minutes longer than I hoped, but hopefully everyone got something out of this. Chris.
Thank you, Don. Well, we are getting some chatter in the Q&A. Let me suggest I am going to be moderating that, so do submit questions. I'm trying to keep the conversation at a high level, so and really on the question of the capital rules. So if you can frame your questions that way, that'll be helpful. I do want to dig into a couple of things, take my moderator prerogative first. One, Don, is that you mentioned this about the issue about pro-cyclicality. And in looking at the rule, I think that's clearly front of mind for FHFA is to make sure that the GSEs are available through the cycle, which, and so this question about how does the capital rule affect that is an important one. Are there ways in which this rule improves on the 2018 proposal in terms of addressing the concerns about pro-cyclicality? In your own writing earlier this year, you noted that that was a failing to some degree of the 2018 rule. And if this rule doesn't do all you would hope, are there ways the rule could, in fact, address pro-cyclicality better?
Okay, so let me go back to the actual economics of the business are highly pro-cyclical with house prices, moderately pro-cyclical with incomes. That creates a conundrum. The banking system is not as pro-cyclical as the GSEs, but they have looked at this issue. Here's your conundrum. So there's no killer app from the banking system of how to do countercyclical. The problem they face is the following. If they have the capital reflect the economics, it will be pro-cyclical going up and down. If they put in a buffer, and the definition of a buffer would be large when times are good and the capital number is low because risks are low, small when the number gets higher because risks are higher, you don't need it, you back into almost a fixed capital system, which can't do anything about and creates terrible, item number two, terrible microeconomics incentives as to how you invest. This is shown in the current proposal. So the first proposal back 2008 was very pro-cyclical. Two things have heavily ameliorated that in this proposal, one more problematic than the other. The leverage ratio being binding is a total solution to the countercyclical problem. It doesn't matter whether risks are high or low, the risk-sensitive measures are not binding. It's the leverage ratio. But then you have all those negative side effects. The banking system has dealt with this, trying to decide whether it should just be judgmental by the regulators or whether it should be a formula, and there is no wonderful solution. The technical item put in by the FHFA here is that the cause of the pro-cyclicality, so much house prices, they put in some a corridor so house prices can't go too awry, high making risks look low or low making risks look overly high. That is maybe an adequate solution that doesn't disrupt the economics too badly. And so that kind of thing is perfectly fine. I have no real problem with that. I have a real problem with the leverage ratio being binding as a way to solve the problem.
With regard to the leverage ratio, for all the reasons you pointed to, they could be problematic, yet they still exist. They're still part of the framework that banks face. Are there circumstances when you would expect them to be binding?
I'll come back to Basel said they want them as a backup and they should never be binding unless something went awry in the risk base. They're worried about gaming as much as anything else. The Federal Reserve is right in the middle now of changing things so it is less likely they become binding. The current vice chairman, who's the first vice chairman for regulation, has made speeches about the bad nature of binding leverage ratios, harkening back to the pre-Basel days when you incent high-risk assets, which they really do not want to do. So I come back to, this is well known, this is well understood. Leverage ratios should be a safety net if something else goes awry. It should not be something you expect to happen.
One other thing I want to just clarify a bit on before we turn over to the question and answer is you built part of your macro framework was looking at the DFAS results,
right.
DFAS Dodd-Frank stress test results coming out of the crisis to say we need to really run financial institutions through scenarios like the Great Recession. So I guess one risk, one concern is that, heading into the last recession, we had models too that were based on, I think, the downturn in the oil patch in the 80s that was supposed to be the worst crisis we ever seen, obviously proved to be insufficient. There's concerns about model risk, how well we're modeling these stresses. And, in the FHFA rule, they point to the fact that there are things that are outside existing models, climate change, pandemics, that we can't account for in our models. And so how much can we really hang our hat on these DFAST results?
Okay, so there are several items in there, and you get to some philosophy about what the private sector can manage in the way of risk versus what government is supposed to manage in the way of risk. I would disagree that there were stress test models being used in substance prior to 2008. I literally talked to a senior bank examiner at the Fed. I was giving a talk to an audience of them in 2010 and talked about stress testing and how it was done at a few banks. And one of them raised his hand and said, I have never heard of stress testing. I've only heard of VAR. The Basel system that dominated prior to 2008, which was put in after the leverage ratio didn't work that well, causing too much high-risk lending, was too oriented towards VAR. And the weakness of VAR is it takes recent history and assumes that is the future. So the Fed stress test, the severely adverse, which became the gold standard, is no cream puff. I come back to, at this point, it's heavily informed by the 2008 financial crisis. And so it maintains market confidence. It did then, it does now. By contrast, when Europe attempted to imitate this, they gave in to their politics and their stress test was considered a cream puff. And the market gave it a big raspberries and they had to redo it a few times to finally get tough enough that it meant something. So the market judgment's pretty good here. So I'm in line with this is adequate, especially when you throw in large going concern buffers. Now, if you want to then say there are other stresses and other risks, the answer is yes. This then gets you down to what's called insurable risk versus non-insurable. Insurable risks are, non-insurable risks are things like earthquake in California. Technically, that risk exists. Everyone knows it's there. There is no way to insure it substantively in any size, at any price. It is just too large a singular event. Therefore, the way this works is that this risk becomes the government's risk. This has specifically been formalized in TRIA, which is the Terrorism Risk Insurance Act, where after 9/11, commercial properties, the insurers didn't want to cover this. It was unpredictable, too extreme. And after long debates and policy work, they figured out the private sector should cover a modest amount, and beyond that, it's the government. And they'll recover the money through tax increases later and such. So if you want to just say everything is so much risk, you need infinite capital for everything, you don't have a financial system. So your financial regulatory system has to make a judgment. What is the normal private sector or insurable risk? And what level of risk goes to, for example, the FDIC for commercial banks and other things. And so right now, I'm okay on the Fed stress test being a derivation of that.
All right, so I'm going to start looking at the Q&A. One theme that's come up, Don, an important part, I think, of your view of this rule has to do with how it treats CRT. So maybe if you could take a minute, I think, first of all, to try to help people understand who may not be familiar with it, a little bit of how CRT works. And I know that's complicated, but and who the investors are, to the extent you're talking about shifting risk elsewhere, who are those investors, and roughly how does it work? And then I got a question about the regulatory aspects of it after you touch upon that.
CRT is as complicated as anything else in mortgages. I'm going to focus on the core, biggest way it happens. This is where a bond is issued, and this bond is a derivation of what's called a cat bond or catastrophe bond, invented a decade or two earlier by the insurance and reinsurance industry to take very excessive, like hurricane risks or other kind of risks like this. And what you do is you pay these investors a return well above a risk-free rate. And what they agree is if you hit the losses as specified in the documents, they don't get back 100 cents on dollar principal. That's what we do. They come by two different names for the two different GSEs, call them just credit risk transfer bonds. So what they will do is say, sell $100 worth of a bond to someone and agree if losses are more than X basis points cumulative on a pool of mortgages, but less than Y, they will absorb that risk and have less principal paid back at the end. How do you know they'll actually pay you at the end? When these losses occur, they give us 100% of the money up front. That's the principal of the bond. A trustee on our behalf, GSE's behalf, holds it, and they get back the unused amount at the end. So you have payment as a virtual certainty. So there's no risk of that the other side somehow doesn't make good on their promise. That's how cat bonds work. That's how these bonds work. The interest rate you pay on these will vary on what the risk is and market's value. This is market discipline from different tranches and how you do these bonds. These bonds focus on risks anywhere from 10 basis points cumulative loss or.
Don, I think maybe we can stop there.
Detail.
But
Okay.
Who are the investors? How many are there, and how diverse are they?
Okay, there are several hundred investors growing. The earliest deals went heavily to hedge funds who took more risky type new instruments, and that quickly evolved to classic institutional investors, asset fund managers, sovereign wealth funds, pension funds, certain insurance company accounts, i.e. it's dominated by non-levered investors, just the classic fixed income market investors.
Okay, with that as background, one of the questions, I might have to read this one to make sure I get it right, says that it seems that the FHFA has a view that a CRT framework needs to be consistent across the banking system without a special GSE construct that's carved out. It seems like they want to wait for the banking regulators to come up with something before granting the GSEs greater latitude to do CRT. What are your thoughts on that?
Okay. Well, I don't know their motivation, so I haven't seen anything in writing that they go, we wish to wait, but that would be cart and horse. The dollars at risk and the focus on CRT is much heavier in the GSEs than the banks. The bank regulators got burned badly by accounting-driven, off the balance sheet, not risk transfer, but accounting-driven transactions in 2008. So they were very skeptical that anything that looked like this worked, and therefore they have a lot of rules that are very anti this. Over time, they learned about CRT. The FHFA over several years educated them. They learned on their own, and they have come around and have started to approve transactions by banks in which they get relief like CRT did under the prior capital proposal. And some banks have started to do these CRT transactions and get capital relief. So in this case, waiting for the banking system to come up with something and the GSEs would follow is definitely cart before horse. The GSEs should be leaders here. The GSE regulators should be a leader here because that's where most of the action is by far.
There's some other questions. I guess one other question is CRT different used by Fannie Freddie. Will this have different implications for the two GSEs given how they perceive the use of CRT? And related to that, I guess, is a question too about is CRT used differently in different segments of the market in terms of the affordable segment versus other segments of the market?
Okay. The regulators shouldn't worry about the company views. It should put out good a regulatory capital system that is right economics. If the two companies then pursue slightly different paths of they think their company is better with a little more risk retention or a little less risk retention, that's just different managements doing things. But I will tell you, it can't be that different given the envelope that they're in fundamentally the same business. Is CRT used differently in different parts of the business? I would say the single family, they're used roughly the same between the two companies other than slight different views of how much risk retention is desirable. Multifamily has quite a different history. Freddie Mac uses CRT very, very extensively, well before single family got going. Fannie Mae used a risk-sharing product that was much less capital-oriented and their numbers are only a fraction what Freddie's numbers are, although they're starting to catch up. Other than the multifamily, single-family difference, I'm not aware of much difference.
So Don, is also, so you mentioned CRT relative to PMI, private mortgage insurance.
Right.
One question that came in is, what's the likely downstream impact on PMIER's capital requirements? I guess the question about how is the GSE capital requirements aligned with capital requirements for PMIs?
Okay. PMIs have a legal regulatory capital requirement provided by their state insurance commissioners. That proved not to be too good in 2008. Of course, they weren't alone in that. That was true for the banking system as well. But they didn't really raise capital requirements after 2008 in the way the banking system did. The FHFA then began a program of saying, while your legal regulator is the insurance commission in your state, your home state, if you wish to deal with the GSEs that I am conservator and regulator of, you have to meet the following eligibility standards. And while there are a lot of details, the main one, you have to be capitalized in the following manner. That became their binding capital constraint, even though it's eligibility standards, it's not their regulators. So that puts the FHFA in, at least in conservatorship, in charge of what you need to have for capital by a PMI. They were way under what the CCF said they should have. What's called PMIERs, that was the eligibility standard, was moved above the level they had. You naturally had the reaction of, that's terrible, of every industry hates capital increases, but they raised it. It was not all the way to be equal to CCF. Then they did a second one, which got them maybe half or 60% of the way to CCF. And a principle was on the table that over time, same risk, same capital, that if the GSEs had an ultimately approved capital system, that would also apply to what the PMIs needed. It is unclear if that would be supported by the current leadership of the FHFA. So you don't know if they would ask for more to keep them in line or not.
There's a question I'm trying that basically says, if the capital rule leads to higher G fees, could policymakers try to incentivize LMI business by varying G fees, imposing an assessment fee for a housing fund or the like? So either way, how does I guess maybe more generally, how does the rule affect incentives for LMI lending versus other segments of the market?
Okay, the GSEs, of course, are targeted at LMI because there's the limit, you can't make large mortgages. And since the GSEs own 45% of the single family first mortgages in America, and that of course very little in jumbos or these other categories, this GSE shrinkage by having their price increased is going to impact the availability of credit and the price of credit. If the FHA does a big take-up, then the net effect will be moderate. Everyone here should understand, when a mortgage originator, a bank or a non-bank, looks to sell that mortgage to the GSEs or someone else, they have somebody comparing prices. For this mortgage with this characteristics, if it qualifies, I'm going to look at Freddie, Fannie, FHA, VA if it works, if it fits their criteria, the PLS market, and even aggregators like a Wells Fargo or JP Morgan Chase that will buy it from me. Which ones gives me the highest price? The GSEs price will move up, they will be less competitive, volume will flow to these others. You have to assume that since the basic economics, higher cost results in less, there'll be less credit availability. The GSEs can still do their affordable goals, they'll just have less money to do it with because they'll have less profits, they'll be smaller. So the impact will be negative on LMI. It's not clear if it'll be modestly negative or heavily negative. But again, because the GSEs are 45% of the business, modest shrinkage by them is still a big thing in the market.
All right, Don, here's a question from someone who knows a thing or two about this. I won't identify him, but he says, how much of Don's $70 to $90 billion excess capital is attributable to unwarranted CRT haircuts?
The answer is, I'm trying to remember the numbers, not half, less than half. Somewhere, I'll just guesstimate from my recollection numbers, maybe a quarter or something. It is not the big driver.
I look at the numbers, Don. It looked like CRT impact under the 2018 rule was to reduce 41 billion. Under the current, it reduces it 22 billion.
So that's about a 20 billion difference out of the 70 to 90. So yeah, quarter or so. Yeah.
Let me see. There was another question that is, let me see if I can try to summarize this. Circumstances where the Fed drives down rates in response to stress, triggering a refinance boom. Is there a legitimate argument that risk may have been pushed out by a CRT, comes rolling back into the GSE balance sheet such that they may need to carry excess capital to absorb not just the deteriorating economics of their own book, but to expand their balance sheet significantly in response to the crisis because of what happens in the CRT market? What's the solution to that?
Can you read that question again? I'm not sure I quite get it.
All right, let me see. So I think the key part of it is that that when the market, we're in a bad market, that there's a rates fall, kind of like we're seeing now, refinance boom, right? So there's all this mortgages coming on the balance sheets, maybe can't do CRT. So now you're carrying excess capital absorb not just the tiering economics of their own book, but their balance sheets are growing.
So let me start with existing CRT on things that don't refinance because it is so well grounded in providing the collateral to us ahead of time is working perfectly fine. If there's losses on old loans, they're covered. There's controversy about some of the original transactions exactly interpreting things, but that's a very limited universe from deals done back in 2013 and 14. The deals have evolved since then. So your book of CRT transactions is rock solid in terms of they are doing what they're supposed to do. The question is, the Fed drives rates down, old loans pay off, so the CRT book shrinks because the loans they're covered shrink, and new ones come on and you can't do new CRT. When we were developing CRT, we went, listen, the GSEs are not bond underwriters. Their balance sheets are not like a bond underwriter, incapable of making new mortgages if they can't underwrite and sell the bonds out. GSEs are giant mortgage credit risk investors, and then they decide if it's economically efficient or not to lay it off to the market. And we thought CRT, because it's a specialty instrument and it's highly structured, might disappear for a year or two. The GSEs would have to keep excess capital to support the mortgages being old school, like they did prior to CRT, own 100% of the credit risk, just like the old days, and then a year or two later start selling the risk off. In fact, CRT has gotten so well developed, they did not disappear until the middle of March. There were transactions literally in the middle of March as the pandemic was going, so they were not among the first to disappear. The people in the business tell me they were ready to do new transactions starting probably in mid-May. FHFA wanted more time for whatever reason, and they have finally approved, and the transactions starting again right now. So it's late June. So you had a delay of a grand total of about 3 months, which in this case is almost insignificant. So the product has proved itself very well, and things are looking good on it. So there doesn't seem to be much problem going on. I also want to note how this crisis so far is so different from 2008. House prices are still going up. Forbearance is a real issue, but as long as house prices stay, which we're not sure of, but so far doing well, then if people have income problems, the net worth of the house makes it a low credit risk item still for the GSEs.
All right, Don, we're just at the 1 o'clock hour. This may be too big a question to ask, but a number of the questions were just generally about the prospects for raising this capital and whether it's, as you say, in the range of 150 billion in your view, or 240 billion as the proposed rule is calling for.
Okay.
A lot of capital.
There's There are a lot of advisors involved in this, and there need to be. This is not a no-brainer. This is so complicated, not just in the technical capital market sense of raising a lot of dollars. First of all, they don't need to raise the 240 or the 170. They need to raise that minus retained earnings, which click over every day and are building up capital. So if they're willing to wait a few years, they'll have a lot less to raise. But there are so many decisions, some of which are highly sensitive politically, to be made, not by the FHFA in its way, but by Treasury. What to do with the senior preferred, consider it paid or not? That's a highly political issue. How do you do this while the lawsuits are still outstanding about the equity ownership? Can you do anything until those are resolved? What is the government going to charge the GSEs on a going forward basis for their support under the PSPA, the support agreement? They haven't even said that. That's going to be a direct charge to the P&L of the companies. Is that going to be 5 basis points, 20 basis points? What are they going to tie it to? Literally no information about those things. So there's so much to be done. You really can't have much an opinion other than there's a lot of wood to chop by a lot of people, not just FHFA and the GSEs. And there's a lot of politics around it all. And a lot of it is not always obviously controllable. That this is a very high hill to climb. And you're talking about at least, other than some kind of publicity stunt deal, at least a year and a half or 2 years before you can see something being done.
Well, it's been 12 years. I think we're going to need some more time to get out of it. They're big, complicated, and important industries. This is obviously an important rule for all the reasons we talked about. I will just want to remind people that this will be posted. We're recording it. It'll be posted on our website. Don's slides will be on our website. If you have some follow-up questions, submit them to the Joint Center email. We'll try to get to people questions we couldn't get to. Don, thank you for sharing your time, your expertise, your perspective with us. I think this has been enormously helpful and informative. And so I hope folks have enjoyed it. And we'll see you next time.
Okay. Thank you, everyone.